for standing by. Welcome to AeroVironment's fourth quarter and full fiscal year 2025 earnings conference call. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you'll need to press star 11 on your telephone. Please be advised that today's conference is being recorded. I would now like to hand the conference over to your speaker today, Director of Investor Relations, Denise Pacioni.
Thank you and good afternoon, ladies and gentlemen. Welcome to AeroVironment's fourth quarter and full fiscal year 2025 earnings call. My name is Denise Pacioni, Director of Investor Relations for AeroVironment. Before we begin, please note that certain information presented on this call contains forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. These statements involve many risks and uncertainties that could cause actual results to differ materially from our expectations. Further information on these risks and uncertainties is contained in the company's 10-K and other filings with the SEC, in particular in the risk factors and forward-looking statement portions of such filings. Copies are available from the SEC, on the AeroVironment website, or from our investor relations team. This afternoon, we also filed a slide presentation with our earnings release and posted the presentation to the investor section of our website under Events and Presentations. The content of this conference call contains time-sensitive information that is accurate only as of today, June 24, 2025. The company undertakes no obligation to update any forward-looking statements, whether as a result of new information, future events, or otherwise. Joining me today from AeroVironment are Chairman, President, and Chief Executive Officer, Mr. Wahid Nawabi, and Executive Vice President and Chief Financial Officer, Mr. Kevin McDonnell. We will now begin with remarks from Wahid Nawabi. Wahid?
Thank you, Denise. Welcome, everyone, to our fourth quarter and fiscal year 2025 earnings conference call. I will start by summarizing our quarterly and full year performance, followed by Kevin, who will review our financial results in greater detail and provide guidance for fiscal year 2026. I will then provide a summary of our key messages, and finally, Kevin, Denise, and I will take your questions. Please be aware that our fourth quarter and fiscal year 2025 financial results do not include any financial activity from BlueHalo acquisition, except for pre-closing deal and integration-related expenses. I'm pleased to report that once again, we have achieved another record fourth quarter and full year results, exceeding our expectations while positioning us for even greater long-term profitable growth. We had an incredible year marked by robust demand for our innovative solutions, which enabled us to achieve double-digit organic revenue growth and significant increase in profitability. Our investments in all business segments helped drive demand for our products, which led to key domestic and international wins and enabled us to launch 3 new groundbreaking products this year, namely the P550, the Jump 20X, and the Red Dragon. Now I would like to highlight our key messages for fiscal year 2025, which are included on slide number 3 of our earnings presentation. First, we achieved record fiscal year revenue of $821 million, which is 14% higher than the prior year period, and record fourth quarter revenues of $275 million, which is 40% higher than prior year period. Second, in fiscal year 2025, we secured $1.2 billion in total bookings, underscoring the robust demand for our innovative and battle-proven solutions. Third, we ended fiscal year 2025 with funded backlog of $726 million, which is 82% higher than the prior fiscal year. Fourth, we closed our acquisition of BlueHalo, further strengthening our industry-leading position as the next-generation defense tech prime, with an all-domain portfolio of innovative solutions across air, land, sea, space, and cyber. And fifth, we are confident AV is better positioned than ever as a result of important company milestones we achieved throughout the fiscal year, and we're setting our fiscal year 26 revenue guidance between $1.9 billion to $2 billion. Let me be clear. In a growing and evolving market, AV's 50-plus years of proven track record of delivering next-generation solutions with a proven ability to manufacture at scale remain key differentiators that sets us apart. We've been working side by side with our customers and the battlefields to help define and deliver solutions which are shaped by real-world threats they face. Over the past decade alone, we have invested nearly $2 billion in R&D to develop disruptive software-defined hardware solutions, and we believe we remain extremely well-positioned to meet our customers' rising demands by delivering them the best-in-class solutions aligned with their needs. As an example, this past fiscal year, we introduced 3 significant new products that are directly aligned to our customers' highest priorities. The first is our new Group 2 AI-driven autonomous UAS, the P550, which leverages a modular open system approach. Second, we unveiled our Jump 20X, which is a vertical takeoff and landing, or VTOL, medium uncrewed aircraft system, or MUAS, engineered to revolutionize shipboard UAS operations. With an advanced heavy fuel engine and fully autonomous takeoff and landing on a moving small battleship, Jump 20X enhances operational flexibility, simplifies refueling logistics, and ensures mission adaptability across diverse maritime and expeditionary environments. And finally, we introduced our new one-way attack drone solution, Red Dragon, which is a fully autonomous capable GPS-denied one-way attack UAS that directly ties to the needs of our U.S. Department of Defense customers. As demand for our new and existing solutions continues to rise, we remain confident in our robust manufacturing capacity to scale at affordable cost to meet our customers' urgent needs. We are confident that we're well-positioned for strong organic growth in fiscal year 2026 and beyond. With that, now I would like to provide updates on each of our 3 business segments, starting with Loitering Munition Systems, or LMS. Our LMS segment continues to drive expansive growth for the company. LMS revenues for the fourth quarter rose 87% to $138 million, and for the full fiscal year, revenues of $352 million were 83% higher. Fiscal year 25 reiterated the importance and effectiveness of all our Switchblade family of solutions. This fiscal year, we secured a total of $477 million in funded contract awards. We also secured the single largest award in our 54-year history with a 5-year sole source Army IDIQ contract for Switchblade products and services valued at nearly $1 billion. International demand for our Switchblade products also remains strong. There are now 8 countries that have placed firm initial orders, and an additional 8 allies actively engaged in the foreign military sales process. With demand for Switchblades on the rise, we remain active in our manufacturing facility expansion efforts in Utah and expect to have initial production capability by the end of this fiscal year. This new production facility will enable us to support more than $1 billion in annual Switchblade revenues. Now on to our Uncrewed Systems segment, or UXS. Our UXS segment posted fourth quarter revenues of $113 million, which is higher than the prior year period by nearly 9%. For the full fiscal year, revenues were slightly lower than the same period last year at $382 million. The Puma AE UAS, a multi-billion-dollar product franchise for AV, remains a profitable and sustainable growth driver for the company. As I mentioned earlier, we introduced our new P550 UAS this past fiscal year. Our P550 will continue to lead the entire small UAS industry with many unique features, and we're expanding our manufacturing capacity in anticipation of increased demand. As we noted last quarter, the Department of Defense announced 2 programs worth over $1 billion in value. We're confident our P550 solution will compete effectively and win key contracts. Our Group 3 medium UAS, Jump 20, has gained significant traction, particularly in the international marketplace. Most recently, we secured a $46 million contract with the Italian Ministry of Defense. Maritime efforts on the JUMP 20X are progressing, and we anticipate strong interest and demand for this in the near future. Additionally, our uncrewed ground vehicle, or UGV business, received a contract to deliver 41 UGVs to the German Federal Armed Forces, with deliveries scheduled for the summer of 2025 through 2027. This represents one of the largest UGV awards in our company's history. We remain confident in our UXS segment's long-term outlook due to market growth, key contract wins, and expanding international opportunities. Moving now to our MacCready Works segment, MacCready Works continues to develop industry-leading next-generation solutions and is the driving force behind our latest one-way attack drone, Red Dragon. Revenues for the fourth quarter rose 24% to $24 million. For the full fiscal year, revenues were $87 million, which was 14% higher than the prior year period. As stated earlier, Red Dragon is a fully autonomous capable, software-defined uncrewed aircraft system that can operate in high-threat, GPS-denied, and communication-degraded environments. This cutting-edge solution includes AV's AVACORE autonomous flight software suite and AV's Spotter Edge perception system, which we believe are the most advanced technologies in the battlefield today. Red Dragon provides critical advantages to warfighters. It is designed to be mass-produced affordably and can be deployed across land and sea. Red Dragon is now part of our Precision Strike and Counter UAS group under our Autonomous Systems segment. MacCready Works continues to push the boundaries on leading-edge technologies, and we anticipate many more solutions from this group in the future. With an excellent fiscal year 25 behind us, we are now setting our sights on further growth as a combined company for fiscal year 2026 and beyond. Having successfully completed the largest acquisition in our company's history, with the addition of BlueHalo, our position as the premier defense tech leader. We're now better equipped to provide our nation and our allies around the world with new and disruptive solutions they need. Our integrated capabilities across every domain, including air, land, sea, space, and cyber, as well as our innovation engine coupled with the ability to scale, positions us to address emerging global priorities and meet rising demand. As an example, recently, the U.S. Department of Defense reiterated the importance our solutions and capabilities play in national defense strategy, from precision fires and loitering munitions, autonomous counter UAS, and to space technologies, cybersecurity solutions, and advanced munitions. As we look ahead and to better align with customer missions and our financial reporting structure, starting in fiscal year 2026, we will operate under two distinct business segments. The first is Autonomous Systems, which encompasses uncrewed systems, or Group 1 through 3 UAS, Precision Strike and One-Way Attack Systems, including Switchblade loitering munitions and Red Dragon, Defensive Systems, or Counter UAS solutions that use both radio frequency sensors and advanced electronic warfare capabilities, Ground and Maritime Robotic Solutions, and MacCready Works, the company's innovation engine where autonomy, AI, and advanced platform technologies converge to deliver next-generation capabilities. The second segment is Space, Cyber, and Directed Energy, which encompasses space technologies, directed energy solutions, cyber solutions, and mission services. By adding space technologies, counter UAS, directed energy, electronic warfare, and cyber solutions to our cutting-edge and battle-proven offerings, we have expanded our growth opportunity in a market fueled by strong tailwinds and now offer a comprehensive set of solutions across all domains: air, land, sea, space, and cyber. With more than 50,000 platforms already fielded and performing in high-demand environments, AV now exports systems to more than 100 allies around the world. Since the close of BlueHalo acquisition, we've been working tirelessly on integration, and we're very excited to finally be one AV team. With that, I would like to now turn the call over to Kevin McDonnell for a review of our fourth quarter and full year financials. Kevin?
Thank you, Wahid. Today I will be reviewing the highlights of our fourth quarter performance, during which I will occasionally refer to both our press release and earnings presentation available on our website. Just a reminder that we closed our BlueHalo acquisition on May 1st, so the results for Q4 and FY25 do not include any financial activity from BlueHalo except pre-closing, deal, and integration expenses. We ended a record year with a record quarter in terms of revenue and adjusted EBITDA. This is the third consecutive year we've met or exceeded our initial annual revenue and adjusted EBITDA guidance. This has been challenging in terms of quarterly year-over-year comparisons, but it's gratifying to end the year with a strong fourth quarter and achieve our annual goals. I'll briefly comment on our results for the quarter and the year and spend a bit more time providing some guidance for FY26, since the financial landscape of the company will change significantly. As Wahid mentioned in his remarks, we ended the year with a record $275 million in revenue in the fourth quarter, which represented a 40% increase over the prior year. This completed a record year at $821 million in revenue, which represents 14% growth despite the challenges of reduced revenues to Ukraine. Ukraine revenues in FY25 ended up being at 18% of total revenue for the year and 12% of revenue in the quarter. We expect Ukraine revenue to be less than 5% in FY26. However, it should be noted that we continue to receive orders for upgrades to their Puma fleet and for Switchblades. It's interesting to note that 52% of the company's revenues were from international customers, of which a little over 24% came from non-Ukraine European customers. We continue to demonstrate a strong international franchise for our Puma, Switchblade, and Jump 20 product lines. In fact, we received orders from 8 countries for Switchblade products worth nearly $250 million in FY25, and the Jump 20 received nearly $100 million of orders in the fourth quarter alone, from which over half came from international customers. As Wahid mentioned, LMS ended the year strong with $138.3 million in revenue in the quarter, of which about 80% came from Switchblade 600 product. UXS had a strong quarter at $112.6 million, which represented 9% year-over-year growth, led by revenues from Puma products, which represented over 50% of the UXS revenue, and the Jump 20, almost 20% of the total segment revenue. In terms of adjusted EBITDA, slides 13 and 14 of our earnings presentation show the reconciliation of GAAP gross margins to adjusted gross margins and net income to adjusted EBITDA. Adjusted EBITDA for Q4 was $61.6 million, up from last year's Q4 of $22.2 million, driven by higher revenue, higher gross margins, and lower investments in R&D spending, partially offset by higher SG&A expenses. Full year adjusted EBITDA was $146.4 million, which is 17.8% of revenue and a 15% increase in EBITDA over FY24. In terms of the fourth quarter, consolidated GAAP gross margins finished at 36%, which is lower than the fourth quarter last year, primarily due to a $4.6 million negative impact due to a non-cash accelerated intangible amortization expenses related to our UGV business. Fourth quarter adjusted gross margins were 39%, a decrease from the 40% for the same period last year due to a change in sales mix and lower service margin. Adjusted product gross margins were flat, while service gross margins were down 8%, primarily due to service mix. Full year fiscal 2025 gross margins were at 41.2% versus 41.5% in fiscal 2024, while adjusted product gross margins improved year-over-year from 43.3% to 43.8%. The 6% decline in adjusted service gross margins resulted in the slight decline in overall adjusted gross margins. Moving to operating expenses. Reported GAAP SG&A for the quarter was $43.3 million, but this includes $5.6 million for deal and integration costs, $2.1 million for a legal accrual, and $0.8 million of intangible amortization. Net of these items, SG&A for the quarter was $34.8 million compared to $32.7 million for the prior year in the same period, a 6% increase. For fiscal 2025, SG&A net of these same types of adjustments was $133 million versus $107.3 million in FY24, or 16% of revenue in FY25 and 15% of revenue in FY24. The increased SG&A is largely driven by increased global sales footprint and, more importantly, increased bid and proposal activity. R&D expense for the fourth quarter was $25 million, or 9% of revenue, compared to $35 million, or 18% of revenue in the prior year. The large year-over-year reduction in R&D was a result of the HAPS flight testing, which occurred in Q4 of FY24. Total R&D spend for 2025 ended at 12% of total revenue and within the 12 to 13% range of our initial guidance. Now turning to GAAP earnings. In the fourth quarter, the company generated net income of $16.7 million versus net income of $6 million recorded in the same period last year. The increase in net income of $10.6 million can be attributed to a $36.3 million increase income from ongoing and big business activities, offset by non-recurring expense from an $18.4 million goodwill impairment in the UGV business, a $5.2 million increase in deal and integration expenses, and a $2.1 million legal accrual. For the full year, the company generated net income of $43.6 million versus net income of $59.7 million in FY24. The decrease in net income of $16 million can be attributed to additional income from normal business activities at $21.7 million, more than offset by the $18.4 million goodwill impairment, $17.2 million increase in deal integration costs, and a $2.1 million legal accrual. Slide 12 shows the reconciliation of GAAP and adjusted or non-GAAP diluted EPS. The company posted adjusted earnings per diluted share of $1.61 for the fourth quarter of fiscal 2025 versus 43 cents diluted share for the fourth quarter of fiscal 2024. Moving to the balance sheet, at the close of the fourth quarter, our total cash and investments amounted to $72.5 million, in line with the same amount at the end of the third quarter of fiscal 2025. Unbilled receivables increased $60 million during the fourth quarter. The increase is largely attributed to the LMS business, as the volume in process switchblades has reached record levels. Contract definitizations, accepts testing schedules, and new payment terms have unfavorably impacted the near-term working capital. We expect favorable improvements to these working capital balances in early FY26. I should note that after the quarter ended as part of the BlueHalo transaction, at closing we paid off the acquired company's debt and transaction expenses, which totaled $925 million, utilizing our $700 million loan facility and part of our $350 million revolving credit facility. Turning now to backlog, our funded backlog at the end of the fourth quarter of fiscal 2025 finished at a record $726.6 million, thanks to a record $1.2 billion in bookings in fiscal 2025. Finally, I'd like to discuss the reporting structure going forward and provide you our FY26 guidance. As Wahid mentioned earlier, AV will now operate under two reporting segments. These descriptions, as well as the pro forma FY25 information for each segment, can be found on slide 10 of the presentation. Total pro forma revenue for 2025 was approximately $1.7 billion for the combined businesses. Our first segment, Autonomous Systems, or AXS, will be led by Trey Stevenson, who formerly led AV's Uncrewed Systems segment. The AX segment is basically the legacy AV business, adding in counter UAS RF, maritime robotics, and electronic warfare businesses from legacy BlueHalo. The total pro forma FY25 revenue for AXS segment is just over $1 billion. Our second segment is Space, Cyber, Directed Energy, or SCDE, and is led by Trip Ferguson, who formerly was the Chief Operating Officer for BlueHalo. The pro forma FY25 revenue for the SCDE segment is $646 million. Starting in the first quarter of fiscal 2026, our earnings results will include disaggregated revenue performance for each of the revenue categories listed on slide 10 under the two product segments. Now, into fiscal 2026 guidance. On page 8 of the presentation, we provide fiscal 2026 guidance inclusive of the recent acquisition of BlueHalo, which closed May 1st, 2025. Given the shift in our financial model, we are giving more color on the guidance for the year. Fiscal year revenue is expected to be between $1.9 billion and $2 billion, adjusted EBITDA between $300 million and $320 million, and non-GAAP adjusted EPS between $2.80 and $3. The midpoint of our revenue guidance range represents nearly 15% growth over the pro forma FY25 results. Our visibility to the midpoint of the revenue guidance range is at 70%, which is at the higher end of our historical range at this point during the year. We expect adjusted gross margins in the range of 29% to 31%. Adjusted gross margins for the first half of the fiscal year should be in the high 20% range, moving toward the low 30% as throughout the year. R&D spend is expected in the range of 6 to 7% of revenue, and BlueHalo deal integration expenses should be in the range of $40 to $45 million, of which approximately $20 million is related to deal closing costs. The revenue for the year should break down to roughly 45% for the first half of the year and 55% for the second half. Overall, adjusted EBITDA percentage of revenue for the year is approximately 16% at the midpoint of the guidance range. This should trend by quarter from 10 to 12% in Q1, trending up to the high teens in the third and fourth quarters as we start to realize synergies, a higher proportion of product sales, and increased revenue levels. Slide 10 further breaks down the expected fiscal 2020